Welcome to vTalkInsight, Market Drivers Daily for May 8th, 2026. Cross currents are intense this morning. Oil is still hostage to Gulf tensions. AI remains the main engine for equities, and fresh U.S. jobs data are challenging the rate cut narrative. Let's start with geopolitics and what the Strait of Hormuz standoff really means for energy and risk assets. Energy risk is still anchored in the Gulf, even as headline oil prices look surprisingly calm. Military incidents and airstrikes around the Strait of Hormuz continue, and Iran is openly using control of this choke point as leverage rather than seeking a quick resolution. Intelligence assessments suggest Tehran can withstand a naval blockade for several months, reinforcing the idea that it can wait out pressure. Yet crude has fallen about 7% over the week, and one-day moves around fresh clashes have been close to 1%, implying markets see a fragile ceasefire holding for now. Beneath that calm, the structure of the oil market is more nervous. Inventories have been drawing down quickly, while some physical benchmarks and petrochemical feedstocks show tightening conditions, especially in Asia, where Hormuz disruptions are most acute. Futures curves are flattening as longer-dated Brent and WTI contracts edge higher, signaling expectations for persistently elevated prices even if spot remains range-bound. If stockpiles are run down while Gulf tensions persist, several analyses point to the potential for a sharp price spike once buffers are exhausted, particularly if unreported storage, for example in China, proves smaller than assumed. The sector impact of this configuration is clear. Energy stocks in Europe are outperforming as Brent holds around triple digits, while travel and leisure, especially airlines, are cutting guidance as fuel costs spike and Middle East routes become more complex. European and U.S. chemical producers that are not reliant on Gulf feedstocks are ramping utilization to fill gaps, but report mid to high single-digit increases in raw material costs. Credit agencies highlight rising pressure in airlines, building materials and chemicals, even as energy and defense issuers benefit from the same backdrop. At the macro level, this leaves an unusual mix. Risk premia remain relatively anchored and U.S. equity indices continue to show resilience, helped by strong earnings and AI enthusiasm, even as consumer sentiment surveys slump on high gasoline prices and cost of living concerns. Compared with yesterday's more relaxed tone after crude softened, today's flow of headlines on ceasefire setbacks and shifting Middle East alliances underlines that a prolonged, low-intensity conflict is the base case being priced. The key watch points are any decisive move on reopening Hormuz, policy steps to cap fuel prices ahead of U.S. elections, and whether corporate earnings in energy-intensive sectors start to force a broader reassessment. From there, the story feeds directly into the AI narrative, which remains the dominant offset to these geopolitical risks. Artificial intelligence is still the central structural force in equities and, increasingly, in macro. Global AI-related capital spending is projected in the high hundreds of billions of dollars this year and could approach $1 trillion next year, with hyperscalers and chipmakers driving the wave. Backlogs in key parts of the value chain have surged to around $2 trillion from under $1 trillion last year, giving multi-year revenue visibility. NVIDIA's multi-billion-dollar data center investment with IREN, Akamai's roughly $2 billion cloud deal with a major AI lab, and expectations for a sizable AI upgrade cycle at Apple illustrate how pervasive this build-out has become. Market leadership has broadened beyond the initial megacap cluster. Semiconductors, memory, industrials tied to data center construction, selective materials, and even some financials are increasingly participating in AI-driven earnings growth, and mid and small caps exposed to the new infrastructure are seeing upgrades. At the same time, index concentration is intensifying. Gains in the S&P 500 since April are still heavily dominated by a handful of very large tech names, and upcoming IPOs of private giants such as space and AI companies could add further weight at the top of benchmarks. The combination of wider participation but heavier index concentration raises obvious questions about portfolio risk if the AI thesis is challenged. Those challenges are becoming harder to ignore. SoftBank has had to scale back a planned margin loan backed by its stake in a leading AI lab, with credit spreads widening and a negative rating outlook highlighting lender unease about private AI valuations. CoreWeave's weaker guidance and share price drop, job cuts, and downbeat forecasts from firms like Cloudflare and Upwork, and rising skepticism about the business models of AI infrastructure providers all point to mounting doubts about whether current spending will generate the anticipated cash flows. Big tech free cash flow has fallen sharply from pandemic-era norms as AI capex absorbs resources, raising the risk that credit markets, rather than equity sentiment, become the binding constraint. Policy and macro feedback loops add another layer. AI is already enabling faster cyber attacks and complex pricing strategies, and companies are using it to justify workforce reductions. Yet labor market data show AI-adjacent professions growing faster than average and no broad-based job losses so far. Large-scale AI investment is putting upward pressure on certain inflation measures, particularly in services and personal consumption components, even as longer-term projections still assume disinflation once productivity gains fully arrive. Bond markets are tentatively pricing a somewhat higher neutral interest rate consistent with that productivity story, but Federal Reserve officials are signaling caution on rate cuts given both AI-related inflation risks and past policy errors. For markets, the watch list includes regulatory steps as industry support for oversight rises, any U.S.-China agreements on AI governance, and evidence that in-demand for AI services is either starting to normalize or moving to the next leg higher. All of this feeds directly into the growth narrative. On the cyclical side, incoming data are tilting the growth story to the upside. April non-farm payrolls rose by about 115,000, roughly 50,000 above consensus, with the previous month revised higher and the unemployment rate holding around 4.25%. Weekly claims remain near multi-decade lows, and the gains are broadening into areas such as construction, manufacturing, and healthcare, alongside faster growth in AI-adjacent professions. Taken together, the figures mark the first run of back-to-back positive job prints in almost a year and reinforce the picture of a labor market that is cooling only gradually. This resilience complicates the monetary policy outlook. Recent labor and inflation readings do not make a compelling case for imminent Federal Reserve easing, especially with strong corporate profits and energy-related price pressures in the background. Several policymakers have signaled a willingness to keep rates on hold for an extended period, and some have even floated the possibility of further tightening if Gulf disruptions keep oil elevated and feed through to broader prices. Markets are beginning to entertain the idea of a somewhat higher neutral rate, partly linked to expected AI-driven productivity, but conviction is still low and rate expectations remain sensitive to each new release. Corporate earnings broadly back the stronger growth narrative. Profit growth this quarter has been notably robust, with materials, energy, and AI-exposed sectors providing much of the upside, and S&P 500 earnings are projected to accelerate toward the mid-20s% year-on-year by the fourth quarter. Individual stories from financial technology firms reporting AI-assisted margin expansion to gaming and prediction platforms posting 20% plus revenue growth reinforce the theme of resilient demand in higher income and digital segments. Yet consumer health is uneven. Gasoline around $4.50 per gallon is straining lower-income households. Survey-based sentiment has fallen to record lows, and energy-intensive industries warn of margin pressure and potential credit deterioration. That mix creates a classic late-cycle tension. One plausible risk scenario for later this year is a combination of still high yields and fading growth momentum as fuel costs and refinancing pressures build, challenging the current constructive stance in risk assets. For now, AI-heavy capex and strong earnings are offsetting much of the drag, and some regions and sectors, from European banks investing in AI to space logistics firms with record backlogs, are leaning into the upswing. Key watch points are upcoming inflation releases, guidance from energy-sensitive sectors like airlines and chemicals, and any change in Fed rhetoric if growth remains strong. Together with the geopolitical and AI dynamics we discussed earlier, these will shape whether today's acceleration extends or gives way to a more volatile adjustment phase. To wrap up, Gulf tensions and the Strait of Hormuz standoff keep medium-term energy and inflation risks in play, even as crude prices have eased near-term. AI remains the dominant structural driver of equities and growth, but its capex intensity, valuation questions, and emerging credit strains argue for close attention to dispersion beneath the headline indices. At the same time, stronger U.S. labor data and resilient earnings are pushing growth risks to the upside and making rapid rate cuts less likely, while pockets of consumer and sector stress hint at possible late-cycle challenges ahead. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.